In today's episode, I'll talk about three interesting stories. In the first story of the day, I'll talk about India's energy strategy, which is a topic that might seem straightforward, but it is actually multi-layered for all of us. In the second story of the day, I'll break down why inflation has been rising and what it really means for you and me as consumers and as investors. And in the third and final story of the day, I'll talk about the World Bank's latest commodities report, which might sound like something that only economists will be interested in, but is actually something that all of you and me must also look at. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is very easy to understand, yet one layer deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 14th of November. By the way, here's wishing a very happy Children's Day to all of y'all watching or listening to this episode. I know most of us are now grown-ups, but it is the inner child in us that keeps us curious. So please don't ever let that die. On that note, let's start with the first story of the day and talk about India's energy strategy. Now, this is a topic that might seem straightforward at first, but it is actually layered with unique challenges and ambitious goals about our country. Now, while many countries are today making big moves towards renewables like wind and solar, India's approach is a little different here. Recently, India's oil minister announced a very interesting strategy. Instead of moving away from fossil fuels, India is now aiming to strengthen its reliance on them. We are setting our sight on becoming a regional refining hub until at least the year 2040. Now, what does this mean, you might be wondering? Look, essentially, India wants to refine oil not just for our own needs, but also for our neighboring countries. There are plans to build more refineries for oil, gas, and petrochemicals. What is interesting here is that in a world that is leaning towards green energy sources, India is now doubling down on oil. Now, mind you, this is not just about clinging to old habits. India's energy demand is massive, and this is fueled by a fast-growing urbanizing population. Currently, our country refines about 5 million barrels of oil every single day, which is roughly 249 million metric tons every single year. But that is not enough to meet India's rising energy needs. The target is 450 million metric tons every single year, and we are far away from it. Now, driving this very goal are state-owned giants like Bharat Petroleum, BPCL, Indian Oil Corporation or IOC, and Hindustan Petroleum or HPCL. Now, each of them has a strategy to expand refining capacity. Let's start with understanding what Bharat Petroleum is up to. See, BPCL or Bharat Petroleum, like I mentioned, is planning a substantial expansion in Maharashtra and Kerala over the next 5 to 7 years. They are adding capacity not just for crude oil, but also for petrochemicals. Now, this is not just fuel. Petrochemicals are also essential to industries like automotive, construction, and consumer goods, from plastic to synthetic fabrics as well. Now, by producing more locally, BPCL is aiming to meet growing demand and reduce reliance on imports. Let's then move on and talk about the Indian Oil Corporation or IOC. Now, for context, IOC is India's largest refiner, and they are expanding their Panipat, Gujarat, and Barauni refineries. Panipat alone will grow from handling 15 million metric tons annually to 25 million metric tons every year. Now, IOC is not just producing fuel, they are also integrating petrochemicals into their refining process, which creates a versatile output which includes gasoline, diesel, and industrial plastics, all of them from the same site. Then there is the Hindustan Petroleum Limited or HPCL. Now, this company has set its sights on diesel self-sufficiency, which is aimed at expanding in Babar, Mumbai, and Vishakhapatnam as well. Now, by 2025, HPCL is hoping to meet all of its diesel demand from local production, and this reduces its reliance on outside suppliers and adds resilience to India's energy network. Now, I'm sure you might be questioning why all of this expansion all of a sudden. See, all of it comes down to India's rapid urbanization and our industrial growth. According to the International Energy Agency or the IEA, India is now set to become the largest source of global oil demand growth by 2030, and it is expected to increase by about 1.2 million barrels per day and make up 1/3 of the global rise in oil demand. Now, this is not just fuel or vehicles. There is also increased demand for petrochemicals like naphtha and LPG, which is used in everything from plastics to industrial chemicals as well. Now, interestingly, as India is doubling down on fossil fuels, some companies are also making very quiet move into renewable energy sources. Reliance Industries, which is a major player in India's oil sector, is now investing in biogas, and they are offering a hint of transition here. Reliance has also earmarked about 65,000 crore rupees in order to build 500 CBG or compressed biogas plants. Now, these would create biogas from organic waste like crop leftovers and food scraps as well. Now, this project aligns with India's SATAT initiative, which is aimed at integrating biogas into the national natural gas supply, which provides a cleaner, domestically produced alternative to imported LNG or liquefied natural gas. Now, the investment in biogas is not just about going green again, it is also a little practical if you think about it. The thing is, CBG is renewable and can also be produced locally. This reduces India's reliance on imported LNG. So while Reliance does remain a heavyweight in oil, it is also planting seeds for a more sustainable future for itself and for the country, so to speak. Now, even beyond refining, India is taking some careful steps towards diversifying its energy mix with biofuels. The government has now set some ambitious biofuel targets, such as blending 20% ethanol into gasoline by 25-26 and also adding about 5% biodiesel to diesel by 2030. Now, ethanol and biodiesel, both derived from crops, offer renewable alternatives that are less harmful to the environment. Reliance's CBG investments are also an add-on to this. With STAT aiming to create a gas-based economy, this also helps reduce import dependence. Now, to further cut its reliance on imported oil, which currently makes up about 87% of supply, India is encouraging domestic exploration. Our country has about 26 sedimentary basins, which are, by the way, geographical zones where oil and gas reserves are likely to be found. But actively, we only explore about 10% of this area. But recently, India opened up 1 million square kilometers of previously restricted areas for oil exploration, and the Petroleum Minister Hardeep Singh Puri has set some ambitious targets for this effort. The aim is to unlock about 22 billion barrels of untapped oil potential in the country. Now, in order to attract local as well as foreign companies, the government is now introducing incentives, simpler regulations, and safeguards against surprise taxes. India's energy strategy might feel contradictory to some people, but it is also carefully balanced if you think about it. On one hand, there is strong commitment to fossil fuels. BPCL, IOC, and HPCL are leading significant refinery expansions in order to meet immediate demand, reduce fuel imports, and also support key industries. But on the other hand, India's renewable investments are also gradually expanding. Biofuels like CBG and ethanol blended fuels offer some alternative domestically produced energy sources. Now, even though they won't quite replace fossil fuels anytime soon, they will help diversify India's energy mix and also provide a buffer against global oil price swings and supply risks as well. Now, even though our country is heavily invested in fossil fuels, we are also committed to climate targets. As the third largest emitter of greenhouse gases, India has pledged to now achieve net zero carbon emissions by the year 2070, and we aim to generate 500 gigawatts of renewable energy by the year 2030, and this will largely be through wind and solar projects. But the thing here is that India is taking a slower approach to fossil fuel reduction. The move towards biofuels and biogas represents a small but a deliberate step towards a cleaner energy future. So as a takeaway for all of us, India's energy strategy is reflective of a smart approach, meeting immediate energy needs through refinery expansions while also cautiously building a foundation for renewable energy. The focus on domestic oil refining reduces dependency on imports and stabilizes energy costs for a fast-growing population. Also, meanwhile, investments in biofuels and biogas signal a gradual shift towards cleaner energy sources, which balances the urgency of current demand with longer-term sustainability goals. So while India's energy landscape might somewhat look heavily dependent on fossil fuels today, there is also a slow but steady evolution underway, which is laying the groundwork for a more diversified and a resilient future for all of us. With that, let's move on to the second story of the day and talk about inflation. Look, India is currently struggling with a very sharp rise in inflation. It has reached levels that could have an impact on pretty much everything, from household budgets to even central bank policies now. The Consumer Price Index, or the CPI inflation, hit 6.2%. And this, for your context, is the highest in over a year and has also crossed Reserve Bank of India's or RBI's upper tolerance limit of 6%. Now, this inflation rate has implications for all of us. It affects how much we spend on essentials and also what choices policymakers make in order to keep our economy stable. With interest rates so high, it is very likely that RBI will have to reconsider any plans to lower interest rates, which is something many people were expecting would boost our growth. So in this story today, let me break down what exactly is happening, why it matters to someone like you or me, and what is exactly causing these price increases in India. Now, for those of you who are new to the markets, a bit of inflation is actually normal and even healthy, so to speak. It is a sign that people are spending and the economy is also growing. But problems actually start when inflation starts to jump too quickly. and that has been the case right now. A quick jump in inflation lowers our purchasing power, and this means that the money in our wallets does not quite buy everything that it once used to buy. Now, for a country like India, where essentials like food and transport make up a huge chunk of household spending, this can put some real strain on people's lives. Central banks like the RBI are responsible for keeping inflation under control. When inflation rises too fast, it limits RBI's ability to support economic growth. Persistently high inflation could force the RBI to keep interest rates high, which could make borrowing more expensive and could limit the ability of people as well as businesses to spend and invest. Now, moving on, let's talk about what exactly is driving the inflation spike this time around. Look, in the month of October, food prices were the main driver of inflation. But it is not just food, both local issues and global trends are also at play here. Let me talk about where prices rose exactly and why. First, let's talk about food, obviously. See, food prices increased by about 10.8% year on year in the month of October, which is the sharpest rise in about the last 4 years. Now, this was not just limited to a few items, it spanned across multiple essentials. Vegetable prices, for instance, jumped a massive 42.2%, which is up from an already high of 36% in September. Staple items like tomatoes, onions, and potatoes saw the biggest increase here due to unseasonal rains and also a prolonged monsoon, which hurt crop yields and disrupted harvesting as well. By the way, what is interesting here is that if we strip out vegetables from the CPI basket, inflation is actually much lower at about 3.6%. This really shows how much of an impact these vegetable prices are having on the overall inflation numbers of the country. Talking about edible oil, those prices rose 9.5%, which is the highest increase in over 2 years now. Now, this was due to a 27% surge in global oil prices, which is driven by poor weather in major oil producing countries. Now, since our country imports most of our edible oils, these global increases directly impact our local prices. In addition to this, in September, the government raised import duties on some oils in order to support domestic farmers, and this added further pressure. Fruit prices also rose by about 8.4%, and cereal prices rose by about 6.9%. Now, these increases are broadly due to supply challenges and also high demand. But interestingly, not everything quite saw a price rise. Spices, for instance, dropped by about 7% year on year, which shows a rare area of decline. But beyond food, the cost of some of the essential services like personal care items also saw a pretty good rise, and prices here jumped by as much as 11% in the month of October alone. Now, even though for some of you this might seem secondary, these rising services costs add a fair bit of pressure to household budgets if you think about it. Businesses also start to face higher expenses like rent and wages, and this could push prices up for consumers at the end of the day. Now, moving on, let's talk about core inflation, which is a measure of inflation that excludes volatile items like food and fuel. Now, this number went up to 3.7% in the month of October, up from 3.5% in the month of September. Now, while this is still below the 4% mark, it still shows how inflation is slowly creeping into areas beyond food and energy as well. And the reason why I'm talking about core inflation here is because this is a fairly useful measure because it gives a very clear picture of long-term price trends. For example, categories like housing, education, and personal care reflect deeper structural factors like rising urban demand and supply constraints. But that said, inflation in India right now is not just about local issues. As I mentioned earlier, there are international factors contributing to the situation as well. One critical factor that is adding pressure is the rising US dollar index, which is now at 106. In very simple words, this means that the US dollar has strengthened by about 6% relative to its base. And this means that it has gotten stronger against major currencies, which includes the Indian rupee. A stronger dollar makes imports like oil and other essentials a little more expensive in rupee terms. For India, this imported inflation, so to speak, drives up domestic prices and makes the RBI's job even tougher. If RBI cuts interest rates here, it could weaken the rupee even further, which could push import costs higher and add to inflation in the end. So in a sense, a stronger dollar sort of binds the RBI, so to speak. And as a result of this, the cost of goods that India imports has gone up by 4.6%, which is the highest figure in the last 20 months or so. And even within India, inflation has risen to 6.4%, driven largely by higher food production and distribution costs. So both imported as well as domestic inflation are contributing to the high prices that we are seeing today, and this makes India sensitive to local and global challenges. So now with inflation above 6%, the RBI is facing a pretty tough decision. Many were hopeful that the RBI would cut interest rates early next year in order to help boost economic growth. But with inflation so high now, it seems pretty unlikely. This is because cutting interest rates in a high inflation environment can push prices even higher by making borrowing cheaper, which therefore increases spending. The RBI's projections had assumed that inflation would cool down in the second half of the financial year, but October's numbers sort of tell us a very different story right now. If inflation does not get closer to 5% by the end of this financial year, the RBI might hold off on any rate cuts, and this could slow down economic recovery even further. But all that said and done, there is definitely some hope for inflation to cool down. A possible bright spot here could be the upcoming Rabi or winter crop harvest. Despite delayed monsoons this time around, water levels in reservoirs in states like Punjab and Himachal Pradesh are currently above average. And this could end up supporting a good winter crop season for us. If this harvest is strong, food prices could definitely come down, provided the supply chain operates smoothly. The second thing here is the events in the international markets like conflicts in the Middle East. Now, this could affect price of key commodities, especially oil. Now, since oil costs impact pretty much every industry, stable global conditions will be very important in order to avoid further price rises here. The third factor here is that the Indian government might step in with measures like increasing import quotas on essential goods or even releasing buffer food stocks to help ease prices temporarily. Now, all of these measures could provide some relief for sure, but they also come with costs, which could affect the government's budget. So a key takeaway from all of this for us as investors is that India's inflation spike is not just coming from one source, it is a mix of local disruptions, global pressures, and ongoing cost issues. With prices rising in both essential and services, households are feeling the strain for sure, and the RBI has come into a tricky position to balance inflation control with the need to support economic growth. The research teams at CareEdge and Motilal Oswal are now suggesting that the RBI might hold off on rate cuts until as much as February 2025. And honestly, this also might make sense. The RBI has been pretty clear about wanting to see inflation consistently below 4% before they even start to consider any rate cuts. Let's now move on to the third and the final story of the day. Look, the World Bank recently released its latest commodity markets outlook. And while this may somewhat sound like something that only economists or traders would be interested in, I'll tell you why this is important for all of us. See, commodities like oil, coal, crops, and metals are the building blocks of everyday life. Whether it is the price of fuel for your commute or even the cost of food on your plate, these commodity prices shape our day-to-day expenses and they influence everything from our monthly bills to the wider economy. So in this story today, let's take a look at how exactly global events are shaping the prices of key commodities and why it, so to speak, affects all of us. And to make it easier for all of us to follow this, I'll break it down into smaller segments. Oil, coal, agriculture, metals, the ripple effects across the economy, and how it all ties back to inflation. So let's begin with segment number 1, which is crude oil. See, this is the fuel that powers almost all of the world. Oil prices are not just about what we pay at the petrol pump, they also set the tone for the broader economy and they affect everything from transportation to also the cost of regular goods. According to the World Bank's projections here, the price of Brent crude oil, which is by the way a major benchmark for oil pricing, is expected to decrease to about $73 a barrel by 2025. Now, this gradual decline is not at all random. It is a result of supply and demand forces balancing out, so to speak. Currently speaking, major oil producers in the OPEC Plus group, which for your reference by the way is a coalition of oil exporting countries, have all agreed to limit their oil production. They have agreed to cut it back by 3.65 million barrels per day. Now, this strategy continuing into 2024 is intended to keep prices steady despite slower growing global economies. But the story doesn't quite end here. Countries outside the OPEC Plus like the US, Brazil and Guyana are ramping up their oil production now. Guyana, for instance, is a new and rapidly growing player which is tapping into its offshore oil reserves and bringing fresh competition into this space. On the demand side, we are seeing slower growth in how much oil the world is consuming right now. The International Energy Agency, or the IEA, is expecting a modest increase of about 900,000 barrels per day in 2024, which is less than previous years. A lot of this is due to China scaling back. China, by the way, has traditionally been a major driver of oil demand, but as its industrial growth has slowed down and EVs have become more popular, the need for oil has started to drop very significantly. In 2023 alone, China had added about 3.5 million electric vehicles, which cuts down its dependence on traditional fuels. Looking even further here, the demand for oil is expected to peak at around 2030, which is driven by a global push towards cleaner energy sources. For countries that heavily rely on oil revenue, this shift brings a huge challenge. They will need to balance today's income with future investments in renewable energy to adapt. Policy changes are also nudging the world away from oil right now. Initiatives like carbon pricing in Europe make oil relatively more expensive than renewable energy sources. The US or the United States of America, through their Inflation Reduction Act, is also pushing billions into energy green projects, which is accelerating the shift to sustainable sources. Now, all of this does not quite mean that oil will go away completely. Its role in our energy mix will gradually shrink. So the question now is, why does oil even matter to us? See, oil prices impact nearly every sector today: transportation, manufacturing, and even food. High oil prices tend to push up inflation because they make transportation and production more costly. And on the other hand, lower prices can create issues for oil-dependent economies. And this is for sure a delicate balance. Now with that, let's move on to segment 2, which is coal. Now, coal, which was once the powerhouse of global energy, so to speak, is seeing a very sharp decline in demand as cleaner energy sources are becoming more and more competitive today. In 2022, coal prices hit 344 US dollars per ton, but by 2023, they had dropped to about 147 US dollars, and the World Bank is expecting this trend to continue going forward, with prices dipping even further in 2024 and 2025. You might wonder why the decline? See, developed economies are now moving away from coal due to environmental concerns and the rising cost effectiveness of renewables. But that said, coal still remains essential in specific regions. For instance, over 70% of India's electricity comes from coal today, and this fuels its rapid industrial growth and expanding electrification. Southeast Asian countries, especially Vietnam and Indonesia, are also heavily dependent on coal for power and their industries. And in China, while coal use for power generation is falling, it remains very crucial for steel production, and it is a pillar of the country's infrastructure development. But the thing is, coal's overall future does not quite look very bright. Renewable energy is increasingly outpricing coal even without subsidies, and this is making coal a very unsustainable choice in many places. Governments are also discouraging coal through policies like carbon taxes now. Financial institutions are pulling away from funding coal projects, and they are turning towards renewables, with organizations like the Asian Development Bank reducing coal investments to focus on cleaner options. And the reason why this matters so much is because coal prices serve as an indicator of how quickly the world is moving towards sustainable energy today. A drop in coal demand means a stronger push towards renewable sources, although for some countries, this transition will be very complex and yet gradual. Now let's move on to the third segment and talk about agriculture, which is a sector that directly impacts what we eat and how much we spend on our food. Now, while the World Bank's food price index has dipped by about 4% this year, certain crops still remain volatile. Maize and wheat prices are lower thanks to favorable harvests in major producing regions like the US and the Eastern Europe. But that said, rice prices have surged and they have climbed by over 20% this year, mostly because of India's export bans. For your context, India, which is one of the world's largest rice producers, have halted exports to control domestic food inflation. This restriction has sent ripple effects across countries which are reliant on Indian rice, such as the Philippines and several African nations as well. Then there is also cocoa, whose price has almost doubled now. Climate issues and past infestations in areas like West Africa, which is home to over 60% of the world's cocoa production, have disrupted yields, which has pushed prices up here. Meanwhile, the prices of fertilizers, although they are down by 23% from last year, is still above pre-pandemic levels due to high energy costs in Europe, which is a major producer. So looking ahead, agriculture is facing some mounting challenges. Climate change is making extreme weather events like droughts and floods a little more frequent than they were ever before, and this threatens food security in vulnerable regions. And of course, all of this matters because food prices directly hit our wallets, especially in low-income countries where people spend more on staples than other things. Now let's move on to the fourth segment, which is metals and minerals. Now, metals and minerals are the backbone of modern economies, essentially for everything from construction to technology also. Copper and aluminium, for instance, are high in demand due to their use in electric vehicles and renewable energy systems. Gold prices have climbed by 27% this year, with central banks stocking up as a hedge against global uncertainties. On the flip side though, iron ore is facing weaker demand here due to China's slowing down property sector. China, by the way, which accounts for over half of global steel production, is seeing much lesser demand for construction materials as its economy is cooling down now. The shift to green energy is also now impacting the metals market. Minerals like lithium, cobalt, and nickel, which are essential for EV batteries, are in high demand today, but they're facing supply chain risks. For example, 70% of the world's cobalt production comes from the Democratic Republic of Congo, or DRC, where political instability is threatening steady supply. Countries are now responding to secure access to these critical minerals. China, for instance, has restricted exports of rare earth elements in order to protect its edge in clean tech. The US and Australia are working on boosting their own mineral production and recycling efforts to reduce import dependence. Now, minerals matter in this case because their prices reflect the balance between industrial demand and sustainability, which shows how we are transitioning towards green technologies. With that, let's move on to the fifth segment, which is the ripple effects of commodity prices. Now, commodity prices, of course, don't just affect their own sectors, they also send ripples across the entire economy. Rising oil prices, for example, increase transportation and fertilizer costs, which in turn drive up food prices. Higher coal prices can shift demand to natural gas and could impact the energy market. Now, the metals market is deeply linked to green energy transition. Shortages in metals like lithium or cobalt can heavily slow down EV production and could delay progress towards lower emissions. At the same time, disruptions like rice export bans or political turmoil in mining regions can ripple through global markets as well, and they could affect food security and our industrial output. Now, finally, let's move on to the sixth segment and connect commodities to inflation. Now, inflation, of course, affects everything from our wages to our savings, and commodities play a huge role in driving it. Falling energy and food prices have helped ease inflation in 2023, but the risks still remain. Geopolitical tensions like those in the Middle East could heavily disrupt oil supplies and also spike energy costs. Similarly, climate events could send food prices soaring, and they could reignite inflationary pressures as well. Long-term challenges like climate change and vulnerable supply chains mean that inflation risks are not quite going away anytime soon. Policymakers will definitely need to walk a fine line trying to keep inflation in check without quite stifling economic growth. So in summary, right now from oil and coal to agriculture and metals, each of these markets impact our lives in countless ways. So it is very important for all of us to understand these dynamics because they help us make a lot more sense of the world and also show us how commodities shape not just our economy but also our day-to-day lives. With that, let's move on to the final section of the day, which is the news tidbits. First, FSSAI, or the Food Safety Security Authority of India, has mandated that all food delivered through e-commerce must have at least 30% shelf life remaining, impacting quality control in quick commerce. Second, Nazara Technologies has launched something called G-commerce, integrating e-commerce in the gaming sector in order to boost revenue for developers by enabling in-game purchases. Third, Samsung stock reached a 4-year low amidst concerns over potential US tariffs and challenges in the AI chip market. Next, ETF inflows globally have hit 1.4 trillion US dollars and have exceeded the record set in 2021, driven by market reactions to global economic developments. That's all the news and stories I have for you today. I hope you found value in today's episode. I'll see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.